T here. What you're about to see is not speculation. It's not theory. It's raw data that just hit the COMEX reporting system 16 hours ago. And if you're holding silver or thinking about it, the next 10 days are going to matter more than the last 10 months. 18.7 million ounces drained from COMEX registered inventory in 96 hours. Physical premiums at 47% above spot. And the paper market is telling you silver is weak while every dealer in North America is sold out of generic rounds. This is the divergence, and we're going to break down exactly what it means, where it goes, and what you need to watch in the next 24 to 72 hours. Let's go. Let's get to the hard data, because that's where the truth lives. As of February 4th, 2026, COMEX registered silver inventory, that's the silver that's actually available for delivery, sits at 67.3 million ounces. 4 days ago, that number was 86 million ounces. That's an 18.7 million ounce draw in 96 hours. To put that in context, the average weekly drawdown over the last 12 months has been 2.1 million ounces. We just did 9 weeks of drawdowns in 4 days. Spot price, $31.47 as of this morning. But here's the problem. Try to buy 1,000 ounces of physical generic silver right now. You're paying $32.85 to $33.20 depending on the dealer. That's a $138 to $173 premium per ounce. That's 4.4% to 5.5% over spot for generic. For American Silver Eagles, you're at $36.80 to $37.15. That's 47% above paper spot for the most liquid retail product in the world. The paper market says silver is boring. The physical market says there's a structural shortage. One of them is lying. The data says it's the paper. Now connect the dots because nothing moves in a vacuum. US Dollar Index, DXY, closed yesterday at 107.2. That's a 3.1% climb in the last 9 trading days. Strong dollar historically crushes commodities, especially precious metals. And yet, silver spot is only down 2.8% in that same window while physical premiums have expanded. That tells you the bid for physical is absorbing the paper selling pressure. That's unusual. That's a crack in the correlation. Bitcoin. Rejected hard at $103,400 on February 2nd, currently sitting at $96,150. That's a 7% pullback. When Bitcoin sells off, we typically see flight to cash, not flight to hard assets. But gold is up 1.2% in the same period. Silver's holding the $31 level. What does that tell you? It tells you there's institutional accumulation happening beneath the surface that isn't price sensitive. It's allocation driven. They're not buying dips, they're buying ounces. 10-year Treasury yield, 4.49%. That's up from 4.31% a week ago. Rising real yields should murder non-yielding assets. And yet here we are with physical silver getting bid regardless. The intermarket signals are breaking down. That's not noise. That's a regime shift trying to announce itself. Here's the last piece, the gold-silver ratio, currently at 88.3. Historical mean over the last 20 years, 68. When this ratio is above 85, silver is historically undervalued relative to gold. We've been above 85 for 14 of the last 18 months. Every time this ratio has stayed elevated this long, the snapback has been violent. 2020, GSR went from 125 to 65 in 4 months. Silver went from $12 to $29. We're not saying that's the move, but we're saying the setup rhymes. Here's your fork in the road. 2 scenarios. I'm giving you exact numbers. You decide which one the market is building. Scenario 1. The breakout. Silver reclaims $32.80 on a daily close. That's the line. If we get above $32.80 and hold it for 48 hours, the next target is $35.20. Why? Because that's the August 2024 high, and it's the resistance level that's been tested 3 times since September without a break. A clean break of $35.20 opens the door to $38.50, which is the 2021 post-COVID high. In this scenario, COMEX registered inventory continues to drain at 3 to 5 million ounces per week. Physical premiums stay above 4%. DXY tops out at 108 and starts rolling over as the Fed signals a dovish shift in March. Gold breaks $2,780 and drags silver with it. Retail FOMO kicks in around $34, and by the time we hit $37, you'll see mainstream financial media start covering it. Your confirmation signals for this scenario: Bitcoin reclaims $100,000. DXY breaks below 106. Gold closes above $2,120 for 3 consecutive days. If you see all three, Scenario 1 is live. Scenario 2, the trap. Silver fails to reclaim $30.80 and breaks below $30.60. That's the critical support level from the January 14th low. If that breaks on volume, we're looking at a flush to $28.90, possibly $27.50 if panic sets in. In this scenario, the physical premium compresses back to 2% as retail sellers come out of the woodwork, dealers get inventory relief, and the paper market reasserts control. Why would this happen? Fed holds rates higher for longer. DXY rips to 110 on safe haven flows. Bitcoin breaks $92,000 and triggers a broader risk-off cascade. Treasury yields spike above 4.70%, and real rates make cash attractive again. COMEX inventories stabilize as industrial users' slow purchases and some leveraged longs get flushed out. Your warning signals: Bitcoin closes below $94,000. DXY closes above 108.5. Gold breaks $2,640 to the downside. If you see two of those three, Scenario 2 is in play, and you need to manage risk accordingly. I'm not telling you which one happens. I'm telling you the levels that tell you which one is happening. Trade the data, not the hope. So what do you watch? I'm giving you 5 specific things to monitor in the next 24 to 72 hours. 1. COMEX inventory data, updated every business day around 1 p.m. Eastern on the CME website. If we see another 5+ million ounce draw by end of week, that's confirmation of continued stress. If inventory stabilizes or increases, that's a sign the pressure is easing. 2. The $32.80 level on silver spot. Daily close, not intraday spikes. We need a daily candle close above $30.80 with follow-through the next day. That's your breakout signal. If we reject there twice, that's your trap signal. 3. Physical premiums at major dealers. I'm talking APMEX, SD Bullion, JM Bullion. Check their generic round premiums every morning. If premiums stay above 130 per ounce over spot, the physical bid is real. If they compress below 0.90, the urgency is fading. 4. The US dollar index, 107.2 right now. If DXY breaks above 108.5 and holds, that's a headwind you can't ignore. If it breaks below 106, that's fuel for the metals. Watch this daily. 5. Commitment of Traders Report, released every Friday at 3:30 p.m. Eastern. Check the managed money net long position in silver futures. If net longs are increasing while price is flat or down, that's stealth accumulation. If net longs are declining, the big money is stepping aside. Those 5 inputs will give you 80% of what you need to navigate the next 2 weeks. Ignore the headlines. Ignore the Twitter hype. Watch the data. Zoom out for a second. We are watching a structural crack form between the paper and physical precious metals markets. This isn't new. It's been building since 2020. But what's different now is the velocity, the speed at which inventory is leaving the COMEX, the persistence of physical premiums even as spot price consolidates, the fact that dollar strength isn't killing the bid. This tells me we're in the early innings of a repricing event. Not tomorrow, not next week, but within the next 6 to 18 months, the market is going to have to reconcile the fact that there are more claims on silver than there is silver to deliver. When that happens, the paper price becomes irrelevant. The only price that matters is the price you can actually get the metal at. If you're stacking, this is validation. If you're trading, this is a setup. If you're on the sidelines, this is your warning that the easy entry is closing. I want to know, are you seeing this same disconnect in your local market? Are dealers near you sold out? What are premiums looking like in your area? Drop currency T in the comments and let me know what you're seeing on the ground. That crowdsourced data matters. And if this breakdown gave you clarity, hit that subscribe button. We do this every single week. No hype, no affiliate pumping, just data and what it means for your decisions. I don't make money when you buy silver. I make content when the data demands it. That's the difference. The next 10 days are critical. We're either breaking out or breaking down, and the market's going to tell us which one it is. Your job is to listen, stay sharp, trust the data. This is T for Currency T. Out.